Everyone, welcome to our Traders Accounting presentation on trader taxation. My name is Raven Johnson, and I'm excited to talk with you today regarding trader taxation and entity formation. A little about myself. I've been with Traders Accounting for close to 15 years now. My background is in entity formation and business management, and I've been doing that for 20 years. Several years ago, I purchased Traders Accounting from its founder, Jim Crimmins, so I am now the proud owner of Traders Accounting. I still speak with Jim frequently, and he is doing well. He's enjoying retirement and happy hour with his lovely wife here in Arizona. Getting back to business, if you are a trader and you have ever asked yourself how to maximize your tax savings, then this is the presentation for you. No matter if you are just starting out or are an experienced trader, taxes are important. The information in today's presentation could save you a ton of cash and answer a lot of questions that, like most traders, you have lingering. On behalf of Traders Accounting, there is no lawyer-client relationship from watching this presentation. The purpose of this presentation is for general information about trader taxation and basic entity formation. Do not construe this as legal advice or tax advice. If you have questions after this presentation, please visit our website, call 1-800-938-9513, or email learn@tradersaccounting.com. The website link, phone number, and email is in the description. The whole reason why you're trading is to make money, right? One thing to realize is that taxes are usually the biggest expense that you have once you start making money. Knowing what to do and how to approach your taxes can decrease that expense. Taxes are just one expense of many for a business, so the approach is important to lower your tax burden. The first point of lowering taxes for someone who trades is to get the classification as an active trader. The IRS will either view you as an investor or as an active trader. If you're an active trader, then you have the opportunity to be taxed as a business. As an investor, you get taxed on the trades you make. For people who have a regular job or earned income outside of trading, they can be classified as a hobby trader. Hobby traders shouldn't deduct business expenses or make the mark-to-market election. A way to get around this is to set up a business. By setting up a business, it will clearly divide what you are doing as an individual versus business. There are special rules that you have to meet in order to qualify to trade out of a business or to qualify for trader tax status, otherwise known as TTS. The qualifications are listed in Publication 550 of the IRS Tax Code, but they are ambiguous and leave this to be an opinion-based subject. Based off of a recent court case, our opinion is that we would like our traders to trade 700 round-trip trades a year. Keep in mind, every open is one trade, and the close is the second trade. We would like these trades to be held in a live, cash, or margin account. We would also like the trades to be held for 31 days or less. Second, we would like for you to dedicate 500 hours or more per year to trading or trading-related activities. That can include physical trading, trading research, or trading education. This will equate to about 10 hours per week. I know many of you probably spend far more than that just on research alone. Lastly, we would like for you to trade 170 to 180 days a year, about 70 to 80% of the year. Again, these numbers are not set in stone. We get these from tax court cases. If you feel like you could, or you are already meeting these numbers, please contact us about a free 30-minute consultation to talk about minimizing your tax liability. If you meet the requirements, we would recommend that you create a business to trade out of. By trading out of a business, this helps avoid the hobby rule. If you have set up a business, you can take tax deductions and carry forward a loss forward to offset future profits. Depending on the tax election, you can take a loss and use it against your other income. These are the other reasons to become a business. IRS reclassification refers to when you are classified as a hobby. When you set up a business, you are taken more seriously and it lowers your audit rate. Again, all of your trading expenses get deducted. Depending on your state and company, you can also receive asset protection. These are cases in which you will need to keep records as the government doesn't have to provide that deduction. Keep track of your deductions. This only counts for an audit. In general, we can typically look back 12 to 15 months and deduct pre-incorporation expenses when you start a company. The clock starts ticking from the time you place the first trade out of the name/EIN of the business. For pre-incorp expenses, we are capped at $5,000 for the first year. Anything over that amount is amortized over a 15-year time frame. So in other words, if you have spent money in the past year on trading-related expenses, we can still capture those business expenses. Once you set up a company, there are other expenses that you can take. This is a starting example list of expenses that you can take. You can take corporate organizational expenses, which are those expenses you take to set up the company, such as setting up the LLC or corporation, equipment purchases, such as computers or monitors. Mileage as a trader can be taken as long as you can tie it to the business. Retirement plans, life insurance, travel, and meals can all be taken as deductions as well. These example deductions also go against your earnings. Let's say you earn $20,000 trading, and then if we get $20,000 in deductions, you are at zero for the year. We will cover what type of business you should set up. If you qualify as a C corporation, you can also cover your medical expenses. Your medical expenses can be deducted by the company. It starts immediately. However, an important item to remember is that anything you want to pay out for medical, you have to have earned in the business. In other words, if you want to write off $10,000 in medical expenses, the corporation should have earned over that amount. It is also important to say that what you write off should be deemed medically necessary, so no unnecessary plastic surgery. There are factors and considerations for which type of business you should set up. These are the type of businesses that can legally be set up here in the United States: sole proprietor, LLC, C corporation, and S corporation. C and S refer to tax statuses. Which one should you set up? They are all set up for different reasons, and they can be helpful for different reasons, but every entity allows you to deduct your expenses. There are some cons for some. Generally speaking, sole proprietor is more audited with no asset protection. It is the exact same as you trading out of your individual name. There is no difference. So, we absolutely do not recommend this as an option for you as a trader. We are finding that LLCs are the more preferred entity, especially with its ease of use. C corporations tend to be for higher earners or for those with a lot of medical expenses, as mentioned. Lastly, trading out of an S corporation isn't typical for most traders. I know many of you say, but my friend is doing it, or my friend uses an S corp for their business. However, what they aren't telling you, or they may not know, is that with an S corp, you have to pay yourself a consistent salary. It is a legal requirement of using an S corporation. When you do this, it adds an additional 15.3 tax. Why do that with a pass-through entity for a home-based business with no employees? To find out which is best for you, set up a time to talk. We will tell you what we think depending on your situation and needs. Go to the link www.tradersaccounting.com/30minutes consult or give us a call at 800-938-9513. One of the most popular questions I get is, in what state should I set my business up in? Because of good marketing and tax laws, many people think they should set up their business in Nevada. If you live in Nevada, then yes, you absolutely should set up your business in Nevada. If not, it doesn't work as well as you think because you aren't operating in Nevada to get those tax breaks. Generally speaking, the state that you live in will require you to register your company in that state. There are a few exceptions, but most do. To keep your life simple, form in the state in which you reside, especially if you're using an LLC. One of the things I want to point out in tax elections is wash sale. I'm going to read the actual IRS language to show how complex it is and explain a wash sale. Disallowance of loss deduction. In the case of any loss claimed to have been sustained from any sale or other disposition of shares of stock or securities where it appears that within a period beginning 30 days before the date of such sale or disposition and ending 30 days after such date, the taxpayer has acquired by purchase or by an exchange on which the entire amount of gain or loss was recognized by law, or has entered into a contract or option so to acquire substantially identical stock or securities, then no deduction shall be allowed under Section 165 unless the taxpayer is a dealer in stock or securities and the loss is sustained in a transaction made in the ordinary course of such business. For purposes of this section, the term stock or securities shall, except as provided in regulations, include contracts or options to acquire or sell stock or securities. Basically, what this is saying is that if you are doing stock or options and you have a position, then sell out of that position. Then, within 30 days, you buy back into that position, or basically the same position, and you have a loss from the first sale, the IRS is going to disallow that loss. They aren't going to let you take that loss. Now they will take the gain. So, if you have a position and you sell out of it and there is a gain, they are going to tax you on that gain if you buy back into that position. They are absolutely going to take the tax on that gain, but they won't let you take the deduction for the loss, which is crazy. They, of course, want their money. As an example, a man with some long-term positions wants to change brokers. He sold all of his positions. He had them for years, and they had substantial gains. Then he went to a new broker and bought back into those positions that he just sold out of. Well, he did this within a week or two and fell into the wash sale time period. So if he had losses, he wouldn't be able to take those losses. But because it was gains, he had to pay tax on the gains. This wasn't ideal, and he had to pay thousands of dollars, and there wasn't anything he could do. The idea behind this is that the IRS is basically trying to avoid people cheating them on taking losses. So, people say, hey, it's December 31st and it's the end of the year, so I'm going to sell this position, but I really want to get back into it, so I will sell on December 31st. The tax year will end and I will get a loss, then buy back on January 1st. IRS says no, they don't want you to do that. That's the logic behind that. There are some ways around wash sales. It depends on what you are trading, but if you are trading stocks and options, you have the opportunity to make the market-to-market election. With this election, the wash sale no longer applies. We are going to cover the advantages of that. One of the things that it changes is your capital income to ordinary income, which is a very jargony way of saying you can save more money on taxes if you have losses. We will get into all of these questions in a future webinar. I want to point out one thing specifically about taxes with traders. Trader taxation has its own rules, codes, and regulations. Not all CPAs are familiar with these rules and tax laws. I can't tell you how many countless victims of poor advice or poor accounting I have had to try and save. The numbers are endless, sadly, especially around tax season. Now, you may love your CPA and think he is the greatest thing since sliced bread, and he may be, but does he understand trading? Is he properly doing your taxes? Is he properly advising you? Is he helping you to save on taxes? The absolute best analogy I can give you is this. It is like going to a plastic surgeon for heart surgery or vice versa. Both are highly recommended doctors and both amazing at what they do, but two totally different industries. It is the exact same with trader taxation. I know this isn't the most fascinating topic for most people, so if you are still awake out there, I appreciate you joining us today. I hope that you found this presentation insightful and informative. If you are interested in trading out of a business, give us a call. Now, time for the Q&A. Can I use an S corporation for trading? No, it is not the entity of choice that we would recommend. An S corp is faced with unnecessary double taxation for traders. What about using Wyoming for privacy? When it comes to setting up things in other states, Wyoming actually doesn't give you as much privacy as you think. It is better than Nevada, but no state really gives people privacy like they claim they do. With the world of technology, if someone really wants to find you, they will. Call us and we will talk about your concerns. I am not making a lot of money yet. Do I need to set up a company? This is going to depend. Do you have expenses? Would you like to make the mark-to-market election? As a business owner, you can still take deductions even though you aren't making money. Does research count towards their trader status? Yes, up to 500 hours, about 10 hours a week. If you don't know if you fall into that category, give us a call. I have a real estate company. Can I use that for my trading as well? Short answer is no. The IRS could classify it as commingling your entities and funds and has the potential to bring you into a higher audit risk. From a liability aspect, I usually prefer that you separate out the funds as well. Is there a home office deduction? Yes, and you should be taking this if you are a trader. There are a couple of ways to take this deduction. Sometimes, depending where you are, there is an actual calculation method. Other times, we can use the square feet of the office. Don't listen to the old wives' tale that a home office deduction leads to audit. That is not true. This is a deduction that you are entitled to. Can I deduct ordinary deductions from capital gains? A lot of the time when you are trading and making money, it is a capital gain. You can absolutely use business expenses to offset capital gains. In fact, the IRS thinks these are good deductions. You can still use the home office deduction, miles, and others. Can I deduct health care? It depends on how you are set up. Every type of company is different. Can I use one company for multiple trading accounts? Yes, you can have as many brokerage accounts under one business as you like. You can also trade stocks, options, futures, forex, binary, and/or crypto all out of one entity as well. Can you use your 401k to trade? This is a great question. Yes, you can. However, any trades that you place in a retirement account does not count towards your number when trying to achieve TTS. That is all we have time for today. Thank you for being here. Please set up a free consultation to go over any other questions you have or to talk about your individual needs. Let us help you save money and do your taxes right.